Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everybody, it's Nicole Benjamin, your host here at Seeking Alpha, to bring to you another episode of our new series, Portfolio Pulse, where, as the name suggests, we're going to be keeping a pulse to all the big financial moves happening in the market. Now, for today's episode, I'm joined by none other than Julian Lin. He's going to be helping us dive into all things IIPR. So without further ado, thank you so much, Julian, for joining us today.
Yes, thanks for having me.
Now, I see you've been here on Seeking Alpha since 2017. So for the people listening in, give us a little bit about yourself. Where do you come from in the financial space? What's your investment style? What sector is your expertise?
Yes, so I started as a reader on Seeking Alpha about a decade ago. I enjoyed investing so much, I decided to start writing. So I've been writing ever since on Seeking Alpha. Since then I started a investing group called Best of Breed Growth Stocks. So a lot of my focus has tended to be on growth stocks, but of course, today we won't be talking about a growth stock. I tend to be more focused on the fundamental side of things, deeping into the financial numbers, so forth.
Now, at the top of your article, you mentioned how President Trump has issued an executive order to speed up the scheduling of cannabis to a Schedule 3. So whether that be directly or indirectly, why does a change in a government list suddenly make a real estate company worth the money?
Yeah, so actually, technically, IIPR would not directly benefit or, as we'll talk later, save on taxes due to cannabis rescheduling. But that said, its tenants stand to see big boosts to earnings, which in turn would boost the credit quality of their landlord, IIPR. And with IIPR trading at a double-digit dividend yield, that means that a boost in tenant credit quality is arguably the biggest catalyst that one could hope for the stock.
Now, you also mentioned in your article that these cannabis companies are paying outsized tax rates because they can't deduct from their normal business expenses. So if the rescheduling does occur, does that mean we're going to start to see these companies get huge pay raises from the IRS?
Yes, exactly. So as you stated, many of these cannabis companies, they're paying maybe even 80% tax rates or even higher. Sometimes they might even be not profitable on a GAAP operating basis, but they're still paying taxes anyway, because again, they're paying effective tax rates based on gross profits. So I estimate that many of the operators, and crucially many of IIPR's tenants, they will swing into GAAP profitability after 280E taxes are resolved due to rescheduling. And that would have obvious favorable implications for the landlord IIPR.
A 16% dividend yield is a sign that usually a company is in big trouble. And you even admit that there might be a dividend cut. So if that is the case, why would this be considered a conviction buy still?
Yeah, so income investors know that dividend cuts are almost never priced in. But I view IIPR to be the exception, at least over the long term. Because in the case of IIPR, even if we assume the company gets no recovery on their current vacant properties, which, by the way, make up around 20% of their overall portfolio, the stock, I believe, already has priced in a dividend cut. So if we assume that they cut to an 85% adjusted funds from operations payout ratio, and adjusted funds from operations is like real estate earnings, the company would be paying out roughly $1.45 per quarter in a dividend, and the stock would still be yielding around 12% on that reduced level. I think that yield is still too expensive given how conservative the balance sheet is here.
You compared IIPR's debt to other REITs that are in the market, like Realty Income, but you actually said that it's a safer option because the debt is so much lower. So for anybody that's considering this for their investment portfolio, can you explain the debt to EBITDA ratio and why investors should care about how much debt a landlord actually has?
Yeah. So unless you're looking at something like a mortgage REIT, debt to EBITDA is the standard when you're judging real estate's leverage. EBITDA is defined as earnings before interest, taxes, depreciation, and amortization. So you're excluding some of these costs to arrive at a more pre-tax cash flow generation level. Because IIPR is a net lease REIT, it means that its tenants are responsible for those real estate maintenance costs, which means that excluding depreciation and amortization actually is fully justified anyways, because they're not going to be paying for that. And investors really should be caring deeply about leverage because real estate companies tend to be highly levered. In my experience, REITs could trade very cheaply, but still prove to be bad investments. And that would be mainly due to these companies heading into bankruptcy or needing to dilute shareholders to pay down debt. But in the case of IIPR, their debt to EBITDA ratio is less than 1.5 times, which is much less than the typical 5 to 6 times of their peers. This means that it has far less risk of bankruptcy or needing to issue common stock to pay down debt, which means that its low valuation, you don't need to take it with a grain of salt. It's really offering a deep margin of safety.
And then I also wanted to ask, you highlight IIPR's preferred stock. So I guess, as somebody's looking into this, what would be the difference between the regular share versus what you would consider the preferred stock in this scenario?
Preferred stock could be considered something in between debt and the common stock. And the easiest way to justify that is before a company can pay even $1 of the common stock dividend, they have to pay the preferred stock dividend in full. What's more, IIPR's preferred stock is cumulative, which means that any unpaid preferred stock dividends accumulate, and all of that must be paid prior to resuming any common stock dividend. So that kind of explains why, as I said just now, preferred stock could be thought of as more of a fixed but more solid yield than the common stock.
Okay, worst case scenario, the government doesn't reschedule cannabis. Does this whole investment thesis collapse, or is IIPR still considered a good investment, a good business with or without assistance from the government?
So if the government doesn't reschedule cannabis, then its tenants would probably experience further pressure. But the key point here is because IIPR is the landlord, it would be in a much safer investment position than the stocks of the tenants. Simply because it would not directly face pressures from price compression. I would still view the common stock as being attractive just because, as just discussed, it's arguably already pricing in that dividend cut. And even if rescheduling doesn't happen, I wouldn't expect the company to need to cut the the rent by 50% across the board. But in my public article, I had noted that even if they do cut the rent by 50%, the preferred stock would still look very safe, right? Because the preferred stock is currently yielding 9.5%, but that dividend is covered 48 times by adjusted funds for operations, and leverage is very low at 1.4 times debt to EBITDA. For comparison, preferred stocks of a similar yield typically are only covered 4 to 6 times by adjusted funds for operations. That's way lower than that 48 times. And they typically have leverage in the 6 to 8 times. So even if we assume that, rent was to be cut by 50%, just a very apocalyptic scenario, the preferred stock still somehow looks safe in that situation. So I'm not worried at all about the government not rescheduling cannabis because both the common stock and the preferred stock still look attractive even in that scenario.
All right, Julian, before we wrap things up here, I want to ask, do you have any final thoughts about IIPR or even the sector in general that you'd like the investors listening today to really just take into account as they consider this for their portfolio?
Yeah, I think the cannabis sector has often been one where investors tend to trade on hype or potential regulatory headlines. But I think IIPR offers a good alternative to those kind of investors who instead prefer to focus on numbers and just pure fundamental analysis there.
Well, there you have it, folks. That's your breakdown on IIPR and a classic example of how one signature on a government document can really flip the script on a stock pick. And thank you so much to Julian Lin for joining us today. And for all of you, go ahead, go to Julian's page, click the follow button, take a look at his investing group, Best of Breed Growth Stocks, and see if that's right for you. And we'll see you here next time on Portfolio Pulse.